Hello, my name is Michael Joyce with JoycePayne Partners, and I'm here to share with you some of our viewpoints for the beginning of 2016. But before we talk about 2016, let's recap 2015, which was really kind of a lousy year. Unless you were invested in some large healthcare stocks or some mega cap stocks or were long futures contracts in the US dollar, really nothing worked investment-wise during 2015. The first half of the year was okay. I mean, the markets were flat, and then summer came, and on the heels of crises in Greece over debt and in China over growth, July was a pretty bad month, and then August made July look pretty good in comparison. September was a down month. October, really a pretty good month. November was flat, and then we slid a little bit again in December. And the real game changers over the past year with the investment markets have been the prices of energy commodities and also the amazing increase in the value of the US dollar. Oil prices are now at a point where they're 70% below where they were 18 months ago. And in fact, where oil prices are right now is below where they were at the low point of the financial crisis in February of 2009. Now, I would argue that the world's macroeconomic environment looks a lot better than it did in February of 2009. And you might say, well, what about supply? You know, OPEC has been really increasing output, certainly more than 7 years ago, as well as a large increase in oil output from the U.S. shale oil producers. Well, U.S. shale oil producers, their production peaked in April, this past April. And it's still pretty high, but it is on the decline. As far as OPEC, the major catalyst there is Saudi Arabia. And Saudi Arabia can make money with oil at $35 per barrel, but they need oil prices a lot higher for them to pay for their social spending and for their budget spending. So while oil could still go down on momentum trade in the near term, we would bet that in the longer term, over the next couple of years, oil prices will end up higher than where they are right now. Now, in terms of the really amazing increase in the value of the US dollar, which has risen against most every currency in the world, a lot of that can be expected. I mean, the Federal Reserve from the United States has been telegraphing that they're going to raise interest rates, and in many other parts of the world, they're cutting interest rates and adding monetary stimulus. So you could expect that the dollar is going to gain value. And in fact, that is a big reason that a lot of the foreign investments were down a lot in 2015. Most of that could be attributed to negative currency movement. But we could also argue that at this point, a lot of the increase in the value of the dollar is already factored into markets. And if that is the case, we could see international investments, non-US dollar denominated investments, do a little bit better in 2016 in comparison. We would also say that perhaps the US economy might be better than a lot expect in 2016. The labor markets right now are really pretty tight. And we're starting to see some inflationary pressures with wages, which could lead to real wage increases. Now, if you couple that with what we call the gasoline dividend, which is the amount of money that people would be spending on gas and fuel if prices were higher, but they can use for other purposes now, that could really create an increase in consumer spending. Now, remember that consumer spending makes up 2/3 of the U.S. gross domestic product. So that could bode good things for the coming year for the U.S. economy. However, we could also make a good case that the U.S. stock market is not going to fully reflect the improvements in the U.S. economy over the next year. As the economy improves, corporate earnings should rise. But also as interest rates rise, valuation multiples such as price-earnings ratios will come down. So while earnings are going up, prices of the stocks aren't going up quite as much as the earnings would imply at that time. And also, remember what we said about the international investments and the monetary stimulus that's going on in those countries. What we have learned over the past 7 years with the U.S. Federal Reserve's quantitative easing is that the markets really like monetary stimulus. So turning now to bonds and debt, which also has been a very eventful year and a negative year. Interest rates have started to rise, and as interest rates go up, bond prices come down. But what happened at the end of the year and has continued into 2016 is that with corporate bonds, and we've seen those markets go down and credit spreads start to widen as investors found out that the liquidity in some of these bonds isn't as good as what they thought. And a big reason for that is some of the unintended consequences of regulation, including the Dodd-Frank Act. You have a lot of natural buyers of bonds, such as banks, who really can't buy them anymore. In fact, inventories of bonds held by U.S. primary dealers are down over 85% since 2007. So you don't have any natural institutional buyers that are making a market. So you're seeing bid prices fall further than what you might expect because of that case. But remember that one of the things that investors fear is fear of permanent loss. And with any stock, you could have a permanent loss from where you bought it. It could go down. But with bonds, they have a catalyst in there, and that catalyst is a set maturity date or set call date. So even though the bid prices might move up and down prior to maturity, as you get closer to the maturity or the call date, the prices should move more closely to that face value, and you'd get paid off at maturity at that level. So really the important thing to look at when you're buying a bond and buying it to hold to maturity is really the yield to maturity at what you paid for it, not so much the movement before the maturity date. So I've been very happy to share with you our viewpoints for the beginning of 2016. If you want to learn more about what we're thinking here at JoycePayne Partners, please visit our website at www.JoycePaynePartners.com or follow us on Twitter at JoycePaynePTRS. Thanks and have a great day.